In just a few weeks, the largest collision in American stock market history begins. No, it's not a crash, not a bailout. It's literally a collision. Trillions in hidden money is about to hit the market, and 90% of investors have no idea it's coming. This collision will create millionaires and destroy portfolios that aren't positioned correctly at the same time. I'm going to show you the exact timeline, the 5 waves of capital flow, and the 6 sectors I believe will either explode or implode depending on one thing almost nobody is watching: the price of oil. Here's what's really happening. This isn't just about AI or any of the headlines you've seen. It's AI debt crashing into a geopolitical oil shock, happening at the exact moment central banks around the world are splitting into 2 opposite strategies we haven't seen in decades. America and Europe, where I am right now, are making opposite bets. America is betting on cheap oil and low rates to keep the party going. Europe is betting on expensive money and higher rates. One of them is catastrophically wrong. I thought hard about making this video because it's information dense, more than people usually want on a Tuesday. But I think you're up for it, and you deserve to understand this. If you agree, drop "deserve" in the comments, and let me show you the 2 futures and why you need to be positioned for both. World 1, Wall Street's world. Goldman and a lot of economists think the Iran war keeps dragging on, oil hits $150, inflation spirals, the Fed is forced to hike, and you get a recession, a stock crash, a housing freeze, and a 401k that takes an ugly beating. World 2, Trump's world. End the war. Oil producers flood the market with cheap supply. Inflation gets killed at the source without crushing the economy. The new Fed chair doesn't need to hike. Stocks rip higher. Housing recovers. The economy booms. Here's what makes this dangerous. These worlds are mutually exclusive. You can't be a little bit pregnant. One side gets rich, the other gets destroyed, and there's very little middle ground. Positioned wrong, your portfolio gets cut in half. Positioned right, this is the best buying opportunity since 2020. This isn't abstract geopolitics. It's your 401k, already loaded with stocks that boom or bust on oil. It's your mortgage rate. Rates up, payments jump hundreds of dollars a month. Rates down, you refinance and save thousands. It's whether your portfolio survives or thrives over the next 12 to 18 months. The good news? This framework works no matter who's president. It's not political. It's understanding what cheap oil does versus expensive oil to every asset class. I put together a free workbook covering everything in this video. Links below, dalio.org/boom. Download it. It's free. And once you learn this, it's a skill you keep forever. I call this the Peace to Prosperity Pipeline. 3 forces, 5 waves, 6 sectors. The forces are what collide. The waves are the order money moves through the economy. The sectors are where it lands or disappears. By the end of this, you'll understand all 3. Understanding the framework isn't enough. You need to position for it, and there's a specific window to do that in. Think back to 2020 and 2021. Airbnb, Coinbase, Roblox, Rivian, the golden IPO summer. Most people thought it was chaos. It wasn't. It was a wealth creation event for people positioned right. In moments like this, investors split into 2 groups. Watchers see the opportunity, understand the framework, but wait for more confirmation. They watch it happen on CNBC, then jump in after the move's already priced in. They're always a step behind. Builders understand the framework before the crowd, position early, size their risk properly, and move decisively when the signal hits, capturing 3 to 5 times the return while the watchers are still thinking about it. Which group are you? Your choice in the next 30 days determines what you capture over the next 5 years. If that's you, drop "capture" in the comments. For those of you who do, I'm running a free 2-hour workshop, How to Turn the IPO Summer into a 5-year wealth machine. We go deeper than any 20-minute video allows. It's this Sunday, yes, Father's Day, at 7 p.m. New York time, free at wealthmachine.org. 10,000 spots and they will fill. I'm not telling you to buy IPOs blindly. I'm teaching you how to read the framework so you can decide for yourself. If you'd rather sit on the couch with a beer on Father's Day, that's fine too. But if you want to build something for your family, show up for yourself. Write Wealth Machine in the comments if you're in. There's no replay. Now let's get into the framework itself, because this is the part that changes how you think about investing. The pipeline has three forces like dominoes. Oil, the rate divergence between America and Europe, and what I call the confidence collision. What happens when Wall Street's models are built on the wrong assumption? Force 1, oil. When a major oil-producing region exits a conflict, the Middle East stops fighting, the Strait of Hormuz reopens, supply floods the market, and prices collapse. When oil collapses, the cost of nearly everything drops with it, because oil isn't just gas prices. It's shipping, it's fertilizer, it's plastics, packaging, manufacturing. Drop oil 30% and the rest of the economy follows with a 2 to 3 month lag. This isn't theoretical. It happened after the Gulf War in 1991 and after the 2015 Iran nuclear deal, when oil fell from $100 to $50 and consumer spending surged. Every real Middle East ceasefire has triggered an oil drop within 90 days. Peace equals cheap energy. Cheap energy equals growth. The savings cascade like a waterfall. Energy companies reprice almost instantly. Transportation follows. Consumer prices fall around 3 months later. Manufacturing costs fall in 3 to 6 months. Most investors only see the first wave, the gas station. That's the edge for you as a retail investor. Here's why. Every major bank's model, Goldman, JP Morgan, Morgan Stanley, assumes the war continues and oil stays between $100 and $150. If oil drops to $60 or $70, those models break, and breaking models forces funds to sell what they bought and buy what they sold all at once. That creates violent, fast price moves. Big institutions can't pivot quickly. They run on quarterly rebalancing, so they'll be 60 to 90 days behind the move. You can move in hours. No committee, no board approval. They're an aircraft carrier. You're the speedboat. Use that. Force 2, the rate divergence. For the first time in modern financial history, America and Europe are running opposite monetary policy during the same global event. America is holding rates steady, resisting pressure to hike because it knows that would kill growth. The European Central Bank just raised rates into a shrinking economy. German, French, and Italian manufacturing are in recession. Consumer spending is collapsing. The only reason it doesn't look worse is the billions being spent on Ukraine. Why would Europe hike into weakness? Because they have no other lever. They can't control oil supply. They import almost all their energy. They can't print the world's reserve currency. They have no diplomatic leverage in the Middle East. Raising rates is the only tool left, and it's like trying to stop a flood with a paper dam. It holds for a while, then breaks. America's playbook is the opposite. Fix inflation through supply, not demand. Flood the market with cheap energy instead of crushing the economy to slow spending. The Fed just had its most divided vote in 30 years. 8 to hold, 3 to hike, 1 to cut. That split tells you the Fed is being pulled in every direction, and the hold the line camp is barely winning. Meanwhile, the Fed's balance sheet has quietly grown back above $6.7 trillion. They're not calling it QE. If it looks like QE and acts like QE, it's QE. Why does this matter to you? When two major economies diverge this sharply on rates, capital moves toward stability and return. If the U.S. holds rates and grows, money pours in from everywhere. If Europe hikes into a shrinking economy, smart money leaves. The last time we saw a divergence like this was 2014. Massive capital inflow to the U.S., the dollar surged, and European stocks underperformed American stocks for the next 3 years. If you're holding international or European-heavy funds, that's worth checking. Force 3. The confidence collision. Institutional investors don't make independent decisions. They follow computer models. Right now, every major bank's model assumes three things. The war continues, oil stays above $100, and the Fed might hike. Three assumptions, and all three could be wrong simultaneously. When every major investor is positioned for the same outcome and the opposite happens, funds are forced to rebalance all at once, and that creates explosive price swings in both directions. The last time we saw this dynamic was early 2020. Nobody expected the speed of the recovery. Stimulus was massive, rates went to zero, and the market ripped higher, minting more new millionaires in 12 months than almost any period in market history. The money wasn't made by people who saw the crash. It was made by people positioned for the recovery before it arrived. This connects directly to AI debt. There's $1.8 trillion in debt issued by Meta, Amazon, Microsoft, and the rest of the tech giants to build data centers. If rates stay high because the war drags on and inflation runs at 5 to 7%, that debt becomes brutally expensive. It's 2008 mortgage crisis logic. Debt that looked fine at low rates, turning toxic when rates spike. If rates stay low, the peace scenario, that same $1.8 trillion stays manageable. The AI bets have room to pay off, and the same companies have a completely different outcome. Same debt, same companies, opposite result, depending entirely on war, peace, and rates. Put it together. Scenario A, peace. Cheap oil, lower inflation, the Fed cuts, AI debt stays manageable, the economy grows, stocks rip higher. Scenario B, war continues, and it doesn't need to escalate, just continue. The occasional drone strike on a tanker is enough to make shipping uninsurable. Oil spikes, inflation explodes, the Fed is eventually forced to hike. The AI debt bubble strains, and you get a recession that hits your favorite tech names hardest. Very little middle ground. Wall Street is heavily positioned for the bad scenario, which means if peace actually holds, the opportunity on the other side is enormous. Here's the order the money moves through the economy, the 5 waves. Wave 1, energy. Oil and gas stocks reprice almost overnight. This is the headline wave, but it isn't where the real money is made. I'd be taking profits and exiting energy producers here, not building a position. Wave 2, transportation, airlines, shipping, trucking. Costs drop, while prices they're already charging stay the same for a while. That gap is pure margin expansion, pure profit. We've been quietly building into this sector for weeks. Wave 3, the consumer. Lower gas prices put money back in people's pockets. Restaurants, travel, retail, things people were putting off. This is the wave where Main Street feels it directly. Wave 4, manufacturing. 3 to 6 months out, lower input costs make U.S. manufacturing competitive again. The Caterpillars, the John Deeres of the world start moving. Wave 5, housing and credit. 6 months in, when most people have forgotten the peace deal even happened, lower inflation lets the Fed actually cut. Mortgage rates fall, housing moves, refinancing picks up, every big-ticket purchase that runs on credit benefits. Most investors only ever see Wave 1 and panic sell energy. The generational money is made in Waves 3, 4, and 5. That's where patience wins. Now the 6 sectors briefly, because this is where I want to leave you with real value. Energy. In a peace scenario, traditional producers could drop 25 to 40%. Infrastructure, pipelines, terminals could actually benefit since more volume flows through them, and Middle East infrastructure needs repair after months offline. The smart move, in my view, isn't out of energy entirely. It's shifting from producers to infrastructure. I made that shift about 9 months ago, a little early, but the logic holds. Transportation. Airlines are essentially leveraged bets on oil. High oil, margins get destroyed. Lower oil, transportation broadly becomes one of the more attractive sectors in the market. Tech and AI. Higher rates and that $1.8 trillion in debt is why Morgan Stanley has called this the AI subprime. If the war ends and rates fall, this becomes the best tech buying opportunity since 2022. How you tell the good from the bad is balance sheets, operating cash flow, and following where institutional money is actually flowing, something I'll go deeper on Sunday. Consumer discretionary, lower gas, lower rates, more spending on travel, dining, home improvement, retail, sectors that have already priced in a lot of pain and have room to recover. Real estate, higher rates have crushed commercial real estate, especially offices. But we've already seen commercial REITs start moving on the expectation that the worst is behind us, stuff that was toxic a few weeks ago. International and European stocks. Europe is in a rate trap, hiking into a shrinking economy because it has no other tool. Last time we saw something like this, in 2014, American stocks outperformed European stocks by roughly 30% over the following 2 years, and the dollar strengthened against the euro. If you hold European or global funds heavy on that exposure, it's worth knowing what you actually own. I want to be honest with you. I don't have a crystal ball. Nobody does. I don't know which world materializes. And I don't know what Iran's leadership decides to do next. What I do know is that the market is priced for one outcome. War continues, oil stays high, rates stay elevated or rise. The way I track what's actually happening is by watching where institutional money moves. Follow the money. I don't care which specific stock makes the money. 10 years from now, nobody remembers the ticker. They just notice their neighbor built something bigger because he was positioned in something they weren't. If the consensus is wrong here, the repricing will be explosive. Fortunes will be made, and unfortunately, some people will get hurt on the other side. This is a big enough moment that you deserve to understand it properly. If you want to learn how to actually follow the money, how to use this IPO summer, and how to position yourself for the next 5 years, join me Sunday, Father's Day, 7 p.m. New York time, free at wealthmachine.org. Write Wealth Machine in the comments if you're coming. We'll be enjoying the rest of the south of France while you think it over. That's where I am, the Côte d'Azur, gloriously blue all summer, which is apparently also why the cats are happy. Wishing you a great year and real success, and I hope to see you Sunday. All the best. If you own silver, coins, a safe, shares, an ETF, or a mining stock, what happens on June 16th could be the single most important day for that position this year. Here's the problem.